Good evening. You're tuned into Business Day right here on ET Now. I'm Avan Dabash. Let's get a glance as to how the markets panned out today before we walk you through the headlines. Well, a very volatile day of trade, and by the end of the day, we simpered down to end absolutely flat. The market breadth turned in favor of the losing side, and broader markets too went on to underperform. Banking stocks though managed to hold out through the day. You had the Nifty, which was high by just about 5 points at 6,054. For the Sensex, high by 0.2%, 20,026. So managing to resurface and hold on to that 6,050 mark for the Nifty. But we get you all of the top stories at this hour after the headlines. The high price of 2G spectrum begins to pinch. Market leader Bharti Airtel and Idea Cellular hiked tariffs by up to 100% as the industry gets the pricing power back. Vodafone may now follow suit. Investors dump Hindustan Unilever on royalty concerns. The stock tanks almost 5% after brokerages go ahead and downgrade the stock. Azim Premji says his son Rishad is not in the race for the job at Wipro for at least the next 2 years. In an exclusive chat on the sidelines of Davos, the economic summit, Azim also says that taxing the super rich may not be a bad idea.
India is India, and one has to be there. It's a very big footprint on the planet.
Short-term concerns apart, there is no shying away from India, says Blackstone Senior Managing Director John Studzienski. Also sees differences between states and the centre coming in the way of growth. Will the UK remain in the European Union? Global markets keep their fingers crossed as Prime Minister David Cameron decides to seek a vote on Britain's continuation in the economic bloc. Straight to all the action on Dalal Street, and as pointed out, we got off to an okay start but didn't even manage to hold on to those gains. There was a lot of intraday volatility, and by the end of the day, flat as a pie for the frontline indices. Similar was the picture with the broader markets too, and once again you saw a degree of underperformance coming in, so they ended in the red by a good 1%. In terms of your sectoral indices, well, you had the banking index, that was a good gainer. Technology followed suit. Real estate, consumer durables, add to that list FMCG on account of Unilever was a tad muted. Some of the top gainers on the index, well, Bharti Airtel spurted up very smartly, Tata Power did well for itself, ICICI Bank notched up, and ITC from FMCG also held out. But some results that came out today, you had Karnataka Bank, and that one fell flat on its face. Lots of concerns when it came to the asset quality. You had the profits, which were high by 11% at 80 crores. Net interest income, 228 crores versus 187. And as pointed out, it was the asset quality which the market really read into, 3.3% in terms of the gross NPAs vis-a-vis 3.2% last quarter, and the net NPAs too rising. Syndicate Bank, it was a pretty similar picture, and the street didn't read into it very well. The profits did come in higher by a good 50% at 508 crores. Net interest income was healthy, higher by close to 5%. But this time around, there was a Q3 tax write-back of 175 crore rupees. Havells also put out its numbers. The Q3 profits came in largely in line with what we were expecting, higher by 20% at 94 crore rupees. Net sales higher by 17% at 1,052 crores vis-a-vis 896 crores. Margins were a bit of a disappointment. Media stocks were in focus on account of results coming out today, and they were received very well. A great set of numbers from Zee Entertainment. Their Q3 profits shot up above street expectations to come in at 193 crores. The net sales too were higher by 24% at 939 crore rupees, largely on account of the fact that the ad revenues this time around surpassed street expectations. The EBITDA margins, that came in at 27.6%, a little higher than what the street was expecting, but it was a contraction on a year-on-year basis. Advertising revenue came in at 509 crores. Sun TV too, you had brokerages giving it a big thumbs up after a stellar set of numbers. The Q3 top-line growth came in at 486 crore rupees versus our estimate of 475 crores. Once again, on the profit front too, it surprised at 190 crore rupees, largely led by the ad revenue growth this time around, which also came as a big surprise, higher by a good 20%. EBITDA was higher by 10%, and you had most of the analysts which foresee all of the troubles behind it and seeing a good up move going forward. ended close to the highest point of the day. The other counter which received its numbers very well was Ajanta Pharma, locked in upper circuit as the profits soared 76% at 32 crore rupees and the net sales came in higher by 37% at 225 crores. Saskin Communications also, that one gave it a big thumbs up. 11 crores is what they clocked in terms of the bottom line. That's higher by a good 8% on a sequential basis. And the sales came in at 89 crores vis-a-vis 87.3 crore rupees. JSW Energy also, that one got a good response to its numbers. The profits came in vis-a-vis a loss this time around, so 311 crores versus a loss of 82 crores. And the sales came in higher by 33% at 2,330 crore rupees, with the margins seeing a good expansion at 36%. And they did clock in a forex loss of 61 crore rupees. JP Infra, in fact, that was a stock which was in focus, not with respect to results, as JP Associates offered 2.79 crores shares on the 24th of January, selling an additional 7.06 crore shares also. So that counter didn't receive it well, and the floor price, remember, will be set on the 23rd. You had Amtech Auto, that was in focus as it plans to sell 5% stake in Amtech crankshafts. And that stake sale will be to a foreign investor for a sum of 22.3 crore rupees. Polaris yesterday came out with its numbers and the street did not receive it well. The consolidated net profit came in at 40 crores vis-a-vis 55 crore rupees, so a downtick on a sequential basis, while the net sales were at 560 crores. United Spirits, though, that one was in the limelight on the upside as Deutsche Bank initiated a coverage with a buy rating, upping the target price to 2,700 rupees. Some of the index losers then, Unilever was smashed flat on its face after a slew of brokerage downgrades. The numbers were obviously not received very well by the street. HCL Technologies was flat, as was Jayaprakash Associates, and BPCL, after seeing a good runner, witnessed quite a bit of profit booking. But moving away from that then and to some news in the telecom space, and in what is clearly one of the largest tariff hikes in recent times, telecom majors like Bharti Airtel and Idea Cellular have hiked their call rates substantially. This move clearly signals the return of pricing power to some of the large operators. Let's get in Gauri Dwivedi, who now joins in with the details. Gauri, this is a huge increase in the call rates. What's the rationale and how much will our bills go up by?
This is definitely a very significant increase in call rates that has been done by both Airtel and Idea Cellular. This has been done in tranches. It's not a single hike in call rates. It has been done in 2 or 3 tranches in the last 1 month. It started in mid-December, and then, of course, it has gone all the way till mid-January. As far as exact hike in tariffs is concerned, industry sources tell us that as far as Bharti Airtel is concerned, for several of its packs, call rates have been hiked to as much as 2 rupees per minute. That's for all post-paid plans. That has gone up from 1 rupee per minute to about 2 rupees per minute. That's a substantial hike. And of course, even as far as Idea Cellular is concerned, its per second plan has gone up from 1.2 paisa per second to 1.4 paisa per second for some plans, and as much as 2 paisa per second for some of the other plans. So definitely a fair bit of increase has happened as far as tariffs are concerned. And another important bit here is that promotional offers like free minutes, free SMSs, all that has been done away with in several of the packs, in several circles for both of these companies, especially for Idea Cellular.
Thanks very much, Gauri, for bringing us all of those details. So clearly, pricing power is returning to the sector. Meantime, as pointed out, Unilever got a big thrashing today, plummeted nearly 5% in trade after a dismal third quarter performance. It was the rise in the royalty which threatened to erode the future earnings as well, and that's what really made the brokerages very bearish on the country's largest FMCG company by revenue. Navneet Saluja joins in from our research team to tell us what exactly D Street has made of Unilever's dismal Q3 numbers. A slew of downgrades coming in thick and fast, Navneet.
Well, that's right. Quarter 3 numbers of HUL clearly disappointed the street, and you saw most of the brokerages either downgrading the stock or they have maintained their sell rating on the counter. Well, the reasons highlighted by all the brokerages are the same, and starting off with volume growth, which was the biggest disappointment in Quarter 3 earnings, which was at 13-quarter low. And if you look at the volume growth, that was at about 5% versus our estimate of about 8%. Well, even the management commentary highlighted that they don't see any kind of improvement in the near future for the volume growth. That will take time. And the other reason was hike in royalty rate, royalty payment, and hike in tax rate. So both these reasons will actually restrict the earnings going forward. Even if you look at the EPS, the target for which has been cut, if you look at CLSA, they have cut the EPS target by around 3 to 7% for FY14 and FY15, and the projections for earnings for FY13 to 15 is only 6% on CAGR basis. In fact, brokerages like Morgan Stanley, they have advised their investors to switch to ITC, stocks like ITC and Dabur, in which they have a buy rating. And if you look at the price range given by all these brokerages, the lowest price range has been given by Goldman Sachs, which is 414 rupees per share. The highest is given by 550, which is by UBS, who have cut the target to about 550 rupees per share. So all in all, it was a disappointing counter, and even if you look at the counter, it's fallen by about 7% in the last 2 trading sessions, and currently it's down below its 200-day moving average.
Thanks very much, Navneet, for giving us all of those details. So future outlook for Unilever also looking very hazy. But moving on from there, Azim Premji says his son Rishad is not in the race for a top job at Wipro, at least for the next 2 years. In an exclusive chat with ET Now's policy editor Supriya Srinath on the sidelines of the Global Economic Summit at Davos, Premji said he has complete faith in Wipro's current CEO, TK Kurian. Let's hear out a slice of that conversation.
Makes sense for him to be responsible fiduciarily for the ownership of Rishad because of his experience. I've never said that he would take over the reins of Wipro. The reins of Wipro are managed by a chief executive officer who's accountable to the board of directors. And he is not in the line for a chief executive officer.
Are we here to presume that for the next 2 years Rishad is not going to succeed you?
Most certainly not.
Not? How happy are you with the company's performance under the new CEO?
I'm very happy with all the fundamental things we have set right. I'm a little disappointed that growth has not come earlier. And I think it will come in the next 6 months. I'm very, very confident it will. Why did it not come 6 months back? I think the size of the install base of the organization to twist it around
Takes
longer than what we anticipated.
Talking about the recent reforms taken by the government, Premji says the 3 years of policy inaction has cost India a lot, and there is some merit in hiking taxes for the super rich in India.
There is a merit in raising marginal tax rates for the very, very wealthy.
And who are the very, very wealthy?
I suppose you define some cutoff limits now. And so far as inheritance tax is concerned, I think there are enough dodges available all over the world where people have been able to dodge out of by creating very complex structures. What you will force very wealthy people in India is to create very complex structures which will still protect them from inheritance taxes.
Why this outcry each time raising taxes comes to the debate, comes to the table? India gets up in arms. This is going to, vitiate sentiment.
This is very focused. I think the government wants to raise some resources. I don't think they'll get too much resources out of it, but they want to send some signals.
Are those the right signals and the right time to send it?
I don't have strong views for it or strong views against it. In principle, how can you say that rich people shouldn't pay more taxes? I mean, you have to be fair in a country with this kind of poverty. And I think the rich people are bringing it upon themselves with their conspicuous consumptions. I mean, it is to a state of absurdity.
And you can catch the entire interview on Davos Direct with Azim Premji at 6:30 p.m. this evening. Hey, how do you pronounce his name? Well, let's get you some more opinion then from Davos. John Studzinski, the Senior Managing Director of Blackstone Group, says that differences between the centre and states are the main deterrents for investors. Speaking on Indian politics, he says that in utopian society, Rahul Gandhi and Narendra Modi could work very well together as they complement each other very well.
People are nervous about India because a lot of the big sound bites. They're nervous about the perception of stagnant leadership. They're nervous about the fact that it's not a federally run country, it's a state-run country, and people that know India have great preference for certain states, and I think they're also worried about the power transition. Corruption continues to be on everyone's mind, but the reality is smart companies understand and have to manage corruption and have to have very strict policies about corruption. So for people to say they're not going to invest in India because of these short-term considerations is rather silly, or is rather rubbish. I mean, India is India, and one has to be there. It's a very big footprint on the planet.
Were you as an investor a little nervous to invest in India, and has that sentiment changed on the ground in the last 4 months?
Now, I don't think you could say you're more confident today. Remember, the issue about investing in India is not the investment. The issue is how you monetize your investment and realize a return. So it's not about the last 4 months. It's about what type of longer-term structures are being put in place in terms of capital markets, longer-term sources of liquidity, so that people can actually sell their assets, realize a profit, sell their shares, realize a profit. And I think those types of things we're still waiting to get a better sense of. You've got an election coming up, and I do think that's an important variable in terms of a vector in terms of the future of the economy and the perception of the economy and the country.
Largely, it is believed that this election will be all about Rahul Gandhi versus Narendra Modi, both individuals known to you. How do you see that electoral space pan out over the next few months? And do you think Rahul Gandhi will at all, if he comes, be able to be a good Prime Minister?
It's too bad you couldn't have a sort of William and Mary, or a sort of a happy partnership there, because the reality is they complement each other very well. I don't like the people who talk about the views that the jury is out on Rahul Gandhi. The reality is he may be the opposite, whereas Barack Obama is an impeccably good campaigner, and that's led him into the White House now twice. Maybe Rahul Gandhi is not the best campaigner, but you know, his father was a very good Prime Minister, and it may well be that he has those same genes, and he will be a good Prime Minister. Mr. Modi, on the other hand, who is, we know out of the textbook of the Singaporean mentor Lee Kuan Yew, is, you know, the great sort of leader when it comes to economic model regeneration. If there was a way that India could be a big enough country to find a way for the two of them to work together, they complement each other enormously. One to do with sort of, one could almost be the head of state and providing one degree of leadership, and one could provide sort of day-to-day management of the economy. It could be a very, very powerful combination for India.
So that's the latest coming to you from Davos Direct. More good news in the pipeline for the oil and gas space. The Cabinet Committee on Investment is likely to meet next week to expedite investment hurdles across sectors. And its very first meeting, the defense and naval clearance to oil and gas blocks, is likely to be on top of the agenda. Nithya Balakrishnan now joins in from New Delhi with an update on the same. Nithya, what does the oil ministry seek, and which companies do the blocks belong to?
That's right. Veerappa Moily is working overtime to ensure that as far as investments go into the oil and gas space, it remains robust in the next couple of months, and also to scale up domestic production, which has been a cause of concern in the recent years. Now, what we're picking up from sources is that the Cabinet Committee on Investment, which was set up last month, is likely to have its first meeting next Thursday, and on top of the agenda includes clearance when it comes to defense as well as from the Navy to 47 oil and gas blocks. What we're picking up from oil ministry sources is that they are seeking defense clearance for 30-odd oil and gas blocks. This includes the likes of Reliance Industries, Cairn, ONGC, as well as BHP Bulletin. And of course, 14-odd blocks have been pending for naval clearance. Now, Veerappa Moily is looking to escalate this matter at the highest level in order to ensure that there is some sort of significant return on investment for $13 billion that have been invested recently into the oil and gas space. And he wants these clearances in place before the 10th round of NERP, which is why they are likely to take this up next week. Clearly good news if defense and Navy sectors actually come ahead and decide to clear these blocks. All oil and gas companies, definitely a huge meeting ahead for them next week as the CCI takes up clearance pending for them.
Okay, thanks very much. That would certainly be a positive for the oil and gas sector. Moving on then, and after the government decided to link gold ETFs and gold deposit schemes, SEBI is now looking at relaxing the minimum requirement of underlying gold for the ETFs. Mrinalini Krishna now joins in live on that story. Mrinalini, to what extent does SEBI plan to reduce the minimum holding of gold?
What we are picking up from sources that SEBI may allow gold ETFs to deposit up to 20% of the underlying gold that they hold with banks' gold deposit scheme. Remember, the current norms say that up to 90%, a minimum of 90% of gold that is held by gold ETFs must be in the form of physical gold or gold-linked instruments, and 10% leeway is allowed for gold ETFs to invest into things like liquid funds so that they can deal with redemption pressure. But clearly, after the move that the Finance Ministry has proposed of linking gold ETFs with gold-linked schemes, gold deposit schemes, so that the domestic gold can be freed up to reduce the dependence on gold imports. This step has been taken. The SEBI, the market regulator, is mulling allowing 20% of the gold ETF assets to be deposited with the gold deposit schemes. Remember, current experts say that not much of gold will be freed up due to this step. It's not going to be a significant impact on reducing the demand for gold, but it's a first step nonetheless in the linkage of gold ETFs and gold deposit schemes.
Thanks very much, Mrinalini, for bringing us all of those details. Moving on then, and it's day 2 of the Finance Minister's visit abroad, where he will be meeting another set of investors in Singapore. P. Chidambaram said that more investor-friendly reforms are in the offing, including the removal of sublimits for FII debt investments. He also added that inflation at 7% is unacceptable, but there is no conflict between the Finance Ministry and the Reserve Bank. Let's hear out more from Sanjeev Vasin of DBS.
The highlight was the steps which he has taken in the more recent past and the manner in which he is going to address the concerns to ensure that India bounces back to a GDP level of 8% within 3 years from now. The efforts he's going to put forth to reduce the fiscal deficit were clearly elucidated and were extremely reassuring that the government has plans in place to implement various strategies to bring the fiscal deficit to reasonable levels over a period of time.
Meantime, UK Prime Minister David Cameron promised today to give Britons a straight referendum choice on whether to stay in the European Union or leave, provided he wins an election in 2015. Cameron ended months of speculation by announcing his plan for a vote sometime between 2015 and 17, shrugging off warnings that this could adversely impact Britain's diplomatic and economic prospects and alienate its allies. Let's hear him out.
The next Conservative manifesto in 2015 will ask for a mandate from the British people for a Conservative government to negotiate a new settlement with our European partners in the next Parliament. It will be a relationship with the single market at its heart. And when we have negotiated that new settlement, we will give the British people a referendum with a very simple in or out choice: to stay in the European Union on these new terms or to come out altogether. If a Conservative government is elected, we will introduce the enabling legislation immediately and pass it by the end of that year, and we will complete this negotiation and hold this referendum within the first half of the next Parliament. It is time for the British people to have their say. It is time for us to settle this question about Britain and Europe.
Okay, let's get in a check as to how the European markets are panning out. And in spite of a series of positive data, you had most of the European indices, as we speak, looking a bit tempered at this point in time. The CAC down by just about 0.2%, the DAX up marginally. Moving on then, you've got the FTSE, which is also marginally in the green as we speak. To the Wall Street then, and the futures are indicating a slightly positive start to trade post strong results from tech companies like Google and IBM yesterday. Some important earnings to watch for will be Apple, McDonald's and Netflix, and it's marginally higher for the Dow futures, the S&P 500 up by 0.5%. But with that, we timed out right here on Business Day. Thanks so much for watching.